Well, happy Monday, everyone. Welcome to our Straddles and Strangles class here today. Maybe some of you are here because you've put in some New Year's resolutions. You're going to do better in your financial future. That would be great. Happy to have you here. Recognize a lot of you here that you're coming week after week. Appreciate seeing you being here. You know, sometimes there's some news events that occur over the weekend and you're thinking, there's got to be some way to be able to trade that piece of news. And we're going to explore a couple of possibilities with that here in our class today. Now, I am joined in the chat by Cameron May. I'm happy Cameron's here. He's a great veteran of the market, fellow coach and friend. He knows he can answer lots of questions. All right. So as you have those questions, go ahead, chat them in. I'll keep my eye on the chat for those questions. Cameron will be watching for those as well. Maybe catch some things that I can't quite get to. Now, I hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. And we'll post educational content, things we notice in the market we think that you might find interesting or propose a question. We'll share that information with you. So follow us. It's a great way to interact with us when we're not in our classes. All right, let's go through our disclosures and lay out our agenda for the morning. Options carry a high level of risk and are not suitable for all investors. What we talked about today is intended for information and educational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. You download that to your computer. It's the most robust version of Thinkorswim. It's a little bit different than the web version and the mobile version. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right, typically in our class, we're going to kind of just take a quick look at what the markets are doing, discuss what's going on there. And then our strategies that we focus on here are straddles and strangles, both selling them and buying them, okay? And we're going to look at a lot of different examples here today. Let's hop over, take a quick look at our markets. Here's our SPX, which we use as a general gauge for what the overall market's doing. Blue line is a 10-day simple moving average. This red line is a 30-day moving average. And then down here, I've got my implied volatility, which is really pretty helpful in our class to have that as something on your charts to refer to. Now, I have talked to you in this class about the Santa Claus rally, and maybe were we going to have a Santa Claus rally, and what would the Santa Claus rally be? So we were really tracking fairly closely the last 5 trading days of the year. It started on the 24th of December. I've got that little yellow arrow pointing to where that day is. And going through today, January 5th. Today will be the last day of the Santa Claus rally officially. And you look at it and you go, well, did it do a whole lot? I'm going to put my mouse right here on the 23rd of December, kind of where that closing price was. And if we were to close right now in the market today, it does not look like we are above where we were the close of the 23rd of December. And even looking at it mostly last week, it was kind of like, ah, man, this Santa Claus rally is looking like a bit of a dud. And sometimes, you know, we see these market patterns, but they don't come to fruition every single year. But it's always good to be aware of them and what could happen. And sometimes we do get some nice little rallies at that point in the year during that Santa Claus time frame. The jury is still out. We still may eke out a little bit of a gain for that whole period. If the market were to close right now, I think would fall a little bit short on that. Oh, somebody said, FibZone says I got stopped out of the Santa Claus rally. You know, that, especially this day here, that would have been Thursday. That was really a steep pullback day that you're like, man, Santa, what are you doing? Giving us lumps of coal here? Yeah, very well could have happened. I can see that happening pretty easily. Now, I want to do some follow-up of a couple of our trades because it always helps to talk about handling, how do we manage the trade once we're in it, right? Because we get in it in our class, but the management of it many times happens outside of our class just due to the nature of what we're doing. Now, in this class, straddles and strangles, I'm going to tell you up front, these are speculative trades most of the time, right? Meaning we're not necessarily know what the outcome is going to be, but we're either maybe expecting a move or we're expecting a collapse and implied volatility, and we're trying to capture that. Now, I'm just going to ask you a quick question, which is there any big news event that happened over the weekend that you can think of that might impact our markets here today? If so, I want you to chat it in, and this is a very specific event that occurred over the weekend. Okay, well, you chat that in. Let's take a quick look at our VIX. We can see at least we're up 0.72 so far today, right? So a little bit of a nudge up there. What would we expect volatility to be doing? Well, we would be expecting it probably to be pulling back a little bit. It's not a huge move in the market up, so maybe just a little move here on the VIX, and it's down 2.5% is all, which is not too bad, and it's generally been in a lower range. So lower volatility conditions typically mean not big expected moves, not a lot of insecurities in the market, that maybe things are just kind of plodding along like we might expect it to be. All right, those of you that are paying attention to the news thought of exactly what I was thinking about. Yeah, we've had this situation in Venezuela going on, and over the weekend, apparently, President Maduro was captured. He and his wife are going to be appearing in court in New York City today, I believe. But it could be a pretty big deal. Now, Venezuela actually does not really contribute a ton to the oil supply of the world and the demand that goes on there. So what would we expect to happen with crude oil? Let's pull up our crude oil futures. We don't really trade the futures in this class, but man, they're helpful to refer to. We might have expected maybe a little bit of a move in crude oil, and it did go up here a little bit, okay? But really, where we're noticing a difference is in a couple of stocks we're going to be taking a look at. First one, SLB, Schlumberger. Look at the pop that it had here today, right? Market closed here Friday, boom, pop up here. Nice big move. Looks like it's up 9.42% today. Was up even higher than that earlier. Let's take a look at Halliburton. Halliburton, pop, right? Nice big move. Now, had we known that this was going to occur, which we didn't, nobody does, right? Maybe we could have got in on a long straddle or a long strangle and expected a big move and try to take advantage of the big move. But it's kind of like it might be over, right? Halliburton, what is it up now? 8.73. ConocoPhillips, we'll take a quick look there. It had a big pop. Looks like it's not holding a lot of that gain. And let's just take a quick look and see where Exxon is. It too had a pop, but it's just staying up there pretty decent, but maybe a little bit more volatile with those, especially that long shadow on the downside of the candle. Okay. SIA says it's the world's largest oil deposit. That's where the world's largest deposits are. Okay. They just said I don't know how it benefits us besides oil. I think the main angle on it, right, at least at this point, for as far as what markets might be concerned, would be the oil. Okay. Not so much in what might be happening with potential drug trafficking and things of that nature. We're maybe just the impact of oil. So strategies we participate with here could be beneficial to that. But I want to take a step back, want to do some trade management with you and show you what has happened in a couple of our trades. Okay, trade number one that we're going to look at is Target, TGT. Well, TGT, bring that stock up here. Maybe let's just look at, say, a 3-month chart. And we did on this trade a short straddle at the 96 strike price. That means we bought 196 put, 196 call. And well, actually, in this case, we sold it. Okay, we sold the put, we sold the call, we collected a decent premium. It was kind of in mind, the reason we were looking at Target, we looked at Etsy as well, was, maybe something would happen in the Santa Claus rally that might be beneficial to a play that way. But really, we got in. We did that 2 weeks ago. We did that on December 20. Let's see, what day was that? December. Didn't mark it here. In any case, we sold it. It's one of these days here. Okay, whatever that Monday was 2 weeks ago in December. And we were just kind of looking at it. And last week, when we looked at it in our class, we were up on it. We were capturing quite a bit of the premium of it. And really, the stock hadn't done a whole lot, which was nice, right? You sell the premium. We're happy to have that come into us, man. That's great. And we said, okay, if we get 70% on it, we're just going to go out. And so we set that order up in our class. And sure enough, that's exactly what happened. Okay. If I come over here to the monitor tab and we look at our target, well, we had a couple of things going on there. We did the short straddle, but then we also kind of for a hedge did a long strangle, buying a long call out of the money, buying a long put out of the money to act as our hedges in case something, just act as our hedges. I'm just going to leave it at that. And it decreased the amount of credit we brought in altogether. But we said, if we get 70% of it, great. So we said, if we can go buy it back at 38 cents, happy are we. We were able to get filled at 36 cents. And it was just like a couple of hours after a class finished last week that happened. It was like, great. Now, some of you might be thinking, well, what's to keep us from doing that frequently? What's to keep us from maybe picking a stock and selling a straddle on it? Nothing, right? Could somebody use that as a potential strategy that they might like to do? Yeah, you certainly could. It's just the idea that you don't have a bias in it, right? We're just kind of expecting maybe implied volatility to collapse and that we get to be the beneficiaries of that. And that's what happened with Target and Etsy from our couple of weeks ago trades. All right. Let's see, the next one up, I want to show you our two trades on Bank of America and Delta. Oh my goodness, that's changed quite a bit since I looked at this one. Okay, last week we put in two trades. We bought a long straddle, which means the same strike price. We did a 55 call and put on Bank of America. We did a 69 call and put on Delta Airlines. Now, they both have about 11 days left. What was the purpose of these trades? The purpose of these trades was to go out and buy some options before people start thinking about them for the earnings season. These financials and Delta Airlines and Bank of America, JP Morgan, Goldman Sachs, those kind of organizations, they kind of kick off our earnings season. And so it's a couple of weeks out, but we thought, let's go buy the premium now while it's cheap. And let's see if implied volatility starts to work in our favor. Okay. Now, when I checked this earlier, the gains were not as big. They were, I'm going to say one was like $5 and the other was like $28. So some big moves have happened since I looked at that earlier today. So here we have it. You can see our call we paid $1.63 for. It's now worth $2.80. That's a pretty decent move. That must mean some movement has happened here this morning. The put is not as valuable. We're really getting it here out of that call. And we're up roughly 21% in the trade. Did we do a whole lot to get that? We really haven't done a whole lot to get that. Bought 5 contracts, right? So a little bit of that increase can help us out. I'll show you the chart in just a minute. On Delta Airlines, let's look here. The call on it as well has gone up quite a bit. We bought it for $279. It's now worth $445. So what would we expect to be happening in the put? Would expect the put to be going down in value, and that's exactly what it's gone down. But the call in both of these cases has gone up quite a bit more. than what the stocks did. So let's take a look at Delta Airlines here first. And I marked the day when we got in, and then it was just kind of flat, 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 flat. And then today, a nice little move up. Now, we could, if we wanted, we could hold on to it and play the earnings, trade with it. Our goal here was if we got a decent return on it before they even got to earnings, we might go ahead and get out. Okay, let's go ahead and plug in what that might be for us. Okay, and we're going to say if we get, we're up about 20% now in the next couple of days, say it moves and we're up 40 or 50%, would you be happy with that kind of a return? Some of you may, some of you might be. Okay, you don't have to agree with me. Look what happened to our implied volatility here. So crept a little, crept a little, crept a little. You know, had looks like it's pulling back a little bit here today because we've gotten a pop on that action. That implied volatility is starting to increase. We can see that in the premiums. Look, the Bank of America, its implied volatility, as we look at it down here, has been really flat. So it didn't really do much expansion. And then today with this pop that it's receiving, then of course implied volatility, typically, although not always, but sometimes it's going to drop when the stock or the market's going up, right? That there's not that big uncertainty, but still the same story. They're gonna announce their earnings. Looks like the 14th, so that'll be on Wednesday next week. Okay, so let's do that. What percent would you be happy with? Just if you feel like you have an answer to that, go ahead and send it in to me in terms of a percent. Would you be happy at 30%, 40%, 50%? What would make you say, let's hit the trade button, get out of the trade and try to lock in that profit? All right, now it looks like we've got a survey out there. Thank you, Cameron. Cameron's letting us know and letting us know, hey, we've got a survey out there today. And you, if you're new, you might not know this, but from time to time, we'll take a survey in our classes and we'll say, you know, how's this session going for you? Super easy survey. There's 2 multiple choice questions. No, not multiple choice. They're a scale of 1 to 10. Put in what your feeling is on a scale of 1 to 10. Plop, plop, click of your mouse, just pop, pop, you're done. There are a couple of questions you can answer if you want. There are things like, you know, what would you like to see in this class? And I also encourage you to use it as a space to communicate something with me like, hey, could we talk a little bit about X, or I'm having a problem with Y? Could we talk about that in one of our upcoming classes? And I love to incorporate your comments, your questions into what we talk about. So feel free to use that space for that as well. Okay, we'll remind you when our survey goes, or when we get close to the end of our class, we'll remind you that that survey is sitting out there. All right, just checking to see if there are questions I need to answer. Okay, so Eric's put in a position, answered the question here. We got the pop, get out now. I'm going to say Eric's probably saying, what are we waiting for? Okay, some of you say 50%, 50%. Yeah, it very well could be. And Eric, you know, some of you might side with Eric and go, hey, that was just kind of easy money. Let's go ahead and lock it in and be out of Dodge, right? That could be. But let's do this. Let's say if we get a 40%. Okay, if we get a 40% return on this spread, let's get out. We're going to, and keeping it intact here. Okay, so we've got 2.72. Oh, I should do this on the calculator on the screen with you guys. Let's do that. 272. Let's clear this out. Times 1.5. That would be a 50% return. Says, okay, if it gets up to 408, let's just get out. Okay. And that would be on our Delta Airlines right now. It's at 320. We're saying, hey, if it gets to 408, get us out. Create closing order. We're going to pop that in. Oops, delete that. Let's go back. Let's try it again. Create closing order, selling the straddle. Let's get rid of one of these. There we go. All right. And we're going to put this in at, what was that, 4.08? I believe that's what our calculator said, 4.08. Limit order, make it good till cancel. And maybe it makes another big move tomorrow, and you're like, it's pretty close to that, just take profit. Some of you might choose to do that, right? Not necessarily hold out for the exactly 50%. You could go in and change it. There's nothing that would keep you from doing that. And this is just going to be a single order here. And we're going to go ahead, we're going to hit our confirm and send. Abby says, why can't we look at the chart and see the trend? Well, we actually did, right? We looked at the chart on both Bank of America and Delta Airlines, right? Because we talked about this is the day we got in. Here's our little pullback. And really, the gain, a lot of us today from that pop. That's what's happening. Interesting because we're playing it for implied volatility increase. And in this case, it looks like it went down a little bit, but yet our premium swelled. All right. Next one, let's do Delta. Let's do the same thing. Let's pull our calculator back up. Clear it out. So you can see, all right, here on Delta, our straddle, we paid $5.38. And on this one, we're not up quite as much on that trade. What if we only go for 40% here? Let's say if we times that by 1.4, that would be a 40% gain. That would be nice. We get 753 out of it. Great. We'll say we're happy campers. We'll get out. We won't even hold it through the earnings. All right. And that was what? 753. Right, we're going to make that good till canceled. We'll see what happens. We'll see if we exited out of the trade by the time we get together next week. With these kind of strategies that we're using in this particular class, it's difficult and probably not a good idea to wait until we meet together again to talk about how to manage it. Okay, because maybe the opportunity got to get out, maybe it's going to be tomorrow. I would want to, let's take action for our class on that move as we manage the trade and then discuss it later, rather than letting the moment go without us and us kind of missing out on that move where we could possibly lock in some profits. Okay. Very good. Yeah, 70 degrees in Tampa right now. John is just letting us know how pleasant it is for him right now. That's nice, John. We've got overcast skies where I am. A little bit on the cloudy side. We're having some storms to breeze through, but we need the storm, so we're happy about that. All right, let's get back to new trades and maybe taking advantage of this situation in Venezuela. What maybe we might consider doing. Now, the stocks that we were looking at, we're going to start with our first one here. We're going to start with Halliburton. Right, that's a pretty decent pop here today. It's up 9%. One of the things that I do have showing on the screen is our market maker move. Our market maker move, remember, goes to the trade tab, looks at what the expected move is for a particular event. Now, usually an event might be something that we know is coming up, like an earnings announcement, or a lawsuit dispute settled, or say maybe for a biotech company to see what the FDA said about maybe a particular phase of the drug that they're going through. They have favorable results or not, that type of thing. And we know they're going to announce on a certain date. And so we know we're expecting a big move. We just don't know what direction that it's likely to move in. Okay. And so we want to take advantage of that possibility. So Halliburton, let's talk about it. In the implied volatility here, we can see there's some decent implied volatility. 54% here in this very first week where the options expire Saturday. It's 10% higher this week than in next week. So what we're going to look at here is just doing a very, very short-term trade where we say implied volatility went up. Let's try to sell it and capture it. And maybe as the events of the week with the news maybe settle down, some of that implied volatility comes out. But we are trying to capture it with this pop that it's having right now. Okay, so what we're going to do, let's see what it's right now. Right now, 32 is going to be our at the money strike price. So 50 by 55 cents isn't too shabby. So let's go here. Let's sell our put for 50 cents here. And then we're going to sell our call for 87 cents here. And you can see my open interest and volume columns. You can see lots of activity there. If there were not lots of activity, we'd be a lot more tenuous about a trade like this. We really would be. This is a little bit lower priced of a stock, right? $32. How much margin is this going to tie up in our account? Well, I tested it earlier. I think we can do a couple of contracts here for $1.44 each, and we would be, our buying power effect would go down $12.94. Now in our class, we'll let ourselves risk $1,500, $2,000 a trade. We really don't like to go above $2,000 a trade. If we wanted to, we could say, okay, that margin that we're going to tie up for this trade, keep it less than $2,000. Okay. So in that case, maybe we could do a third contract here. Let's see if that stays below 2,000. Yeah, 1937. So it stays below that 2,000 mark. Now, by selling the option, what are we on the hook for here? Okay, what is our potential obligation that we want to make sure we know and understand? Our intent is not necessarily to have this happen, but theoretically it could. All right, so our short put means we could have this stock put to us at the strike price of $32. Okay, that's our potential obligation, is to say, okay, got to purchase it in our account. That's why they're tying up some margin there, part of the reason. Okay. On the call side of things, what's our potential obligation there? Well, that we will deliver the stock to somebody else at the strike price, right? That's what our theoretical obligation is. So we'll look and see. Our intent here is to try to capture the implied volatility, capture the pop in the price, and let's just see if we can milk a few bucks out of it this week. Certainly the expiration would be on Friday, but I would expect we're actually going to be out before then, maybe by Wednesday or Thursday. That's what I would hope to have happen. Now, the other thing we might want to do here is just put in, hey, if we get X percent of this, let's just get out. Let's be happy campers and be on our way. In a week, I mean, time decay should happen very rapidly, right? This is the last week of these options live. And so, yeah, we're selling the premium and we're going to expect it to just be like an ice cube melting before our eyes in terms of what happens with the price. However, if it moves really big, that won't be the case. Okay. In this case, we're wanting it to not really move so big now that we already got the big move and we're trying to capture it. Okay. Percentage share. What would you be happy with the percent of $1.42? What if we got 60% of that? Would you go, that's nice, let's get it out and be on our way? Let's go 60% on this trade, okay? And we'll put the order in right now as we put in our beginning order. So $1.42, and we'll say create an opposite order. We'll have our calculator. And if we have $1.42 and we've captured 60% of it, then only 40% is left. Okay, so we'll multiply this by 0.4. And so we'll go buy it back at 56 cents, right? Maybe we don't have to do a whole lot for that. Maybe we don't, maybe we do, right? We don't know exactly what's going to happen. We know what we want to have happen, but nobody really knows what's going to happen. We'll make that good till canceled. And if the value of that ice cube melts down, so it's down to around 56 cents, we want to be out of it. Okay? Yeah. Just looking at some of the comments here. Somebody made out like a bandit on something here. FibZone made out like a bandit. Sharing that information with you. Good. The question is, so indicators that the price is likely to go higher? We don't know, Avi. That's a great question. as we look at the chart, we see the big pop. We see that it was just kind of floating along here, mostly sideways for most of the last 3 months until this news over the weekend. Okay. Yes, it could continue to climb, and if that's the case, that might not help this trade. But the expectation is here that it made the big new move. It's 9%. Let's see if it just kind of stays there and that the time decays. That's going to be what our plan is for this one. All right, so we're going to send it on in, and we're going to put this in our straddles and strangles folder so that we can keep track of it. And maybe the price changed a little bit here. $1.42. Okay, we'll see. We'll let it sit here for a minute. Hopefully that will fill here in just a minute. If not, I'll have to go back and change the price. So yes, on that trade, selling the put, selling the call, same strike price. It was the 32s, which is the at the money right now. Okay, that's the one that we did. All right, let's look at this one. This one we're going to kind of do a little bit faster because we're just kind of going to piggyback on the same idea. We're going to do SLB here. I guess they've changed their name. They're not Schlumberger anymore. I guess they're SLB Limited. That's probably a little bit easier for people to say. They probably had their name mispronounced a lot. Maybe they didn't like it. In any case, big pop here. It's up 10% now. Okay. The market maker move, I hope you have this. I share this with you pretty much every week, what that market maker move is. So let me share that script with you. Remember, scripts are never guaranteed as to accuracy or timing, but you're welcome to use them. What does this script do? It looks at the trade tab and says, what's the move that it's expected, the market maker move, right here about $1.37, either up or down. We don't know what direction. And then it kind of maps it out here on the graph so we can see, okay, that amount down is this yellow line, that amount up is this top yellow line. And then right here in the yellow is where you can see that $1.37. Okay. That's the expectation. But the same thing here, we got the big pop. We're hoping to capture that. We're going to go out, we're going to try to capture that premium and move on if we get it. Okay. Same thing here. We're going to do the same strategy where we're going to use the January 9, so they expire this coming Friday. Current price is 44 and change. So let's do our at the money. Let's do 44.61 and 44 for 88 cents. That'd give us about $1.59 of credit. I think we're only going to be able to do 2 contracts here and keep it under a couple thousand. Yeah. Because then our buying power effect, it goes to 1768. And really that's the margin they're withholding. And again, we have the same obligation. We might have to buy the stock at 44, or we might have to deliver the stock to somebody else at 44. But hopefully it just kind of bobs along and doesn't do a whole lot while we kind of wait for this news to settle. Hopefully we've been able to capture that premium. We're going to do the same thing here when we get a chunk of it. We did 60% the last time, right? Let's do another 60%. Right? If we $1.69, if we get 60% of that, only 40% is left. Multiply that by 0.4, and we're going to go buy it back at 67 cents. First trigger sequential, create opposite order, and we'll put in 67 cents there. Make it good till canceled. We'll see what happens. Again, I expect us to be out of this before we meet next week. All right. Futures wants to know, how do I find the market maker formula? What a great question you ask there. Really, the market maker formula is using the at the money strike price. In this case right now, it's 44, and basically adding it together. Okay. If we add together, say 85 and 82, maybe actually the midpoint between these two, midpoint between 78 and 83, midpoint between 70 and 85, add those two together, And that's essentially what the market maker move is. So if the market maker move is not showing on any stock, because it doesn't show for all of them, if it's not showing there, that's how you could go in and determine what the market's expecting, what's been priced in there. Great question. All right. Next up, we're going to just do something non-oil related here. Before we do so, I want to put in a quick plug for our live events. We do some nice live events, and if you haven't been to them, if you haven't been to one before, you might want to make it a goal this year to go to at least one of them. Okay, let me get to get over there. And I'm going to go into our Charles Schwab. Okay, you log into your Schwab account, come over here to learn, come over here to Schwab coaching. And this is where you see our calendar for the week, what's going on, right? You can view what our calendar is for upcoming classes throughout the week, but then this is what I wanted to show you, the in-person events, the live there. We've got a ton lined up for this year. Last year, we really stepped it up. We had more events last year than we've had, I think, in years, okay? And so this is kind of the layout here. We've got an event in Dallas. That's going to be this coming weekend. Some of you might be already registered for that. There's Bellevue that's coming up, Sacramento, San Diego Market Drive event, which is a one-day event, Atlanta, Denver, Dallas again, Boston. Trying to hit the major areas where we have a lot of Schwab clients that might want to participate in this. So, some people, it's not going to come to your hometown. My hometown of Lehi, Utah, we're never going to come to, okay? So you pick a place maybe you might want to go, maybe make a little short vacation out of it, right? And go enjoy the workshop, enjoy the sites for a couple days, make it a nice event. So just want to let you know, if you think you're even remotely interested, enroll, click on the Learn More and register, because otherwise you will miss out on it, okay? Because we when we get full and we say, sorry, we can't accommodate anybody else. Now, hope you become a Schwab coaching webcast follower with our Trader Talks channel. Makes it easy to find our content this way. Right now, we're doing straddles and strangles. Next up is going to be Barb Armstrong. She'll be teaching a smaller account. Some of you love her class. She'll be right at the top of the hour, but you kind of see what's going on here. It helps you find our content. We have playlists for every single class. So if you wanted to go back and maybe listen to last week's class, you could come in here to the playlist, come down and find our straddles and strangles class. We were talking about, did we get a Santa Claus rally? And we're still kind of waiting on it to see, right? But you can go find those. Cameron does a lot of great teaching. If these strategies are new to you, the option strategies are new, long calls, long puts, short calls, you want to get to Cameron's May class, which he teaches getting started with options. And he starts with a really basic class. What's a call? What's a put? What does it even mean? Okay, goes through that with you so that you can ramp up into the different option strategies. So don't shortchange yourselves, okay, guys? That is kind of my direction for you there. Oh, see, is going to be missing the Dallas event. Well, we'll probably be back there. Yeah, you'll catch it towards the end of the year. Yeah, you can see. How soon can you watch this session? Well, it'll go through a brief review. All of our sessions do. And if I don't blow it and say something I shouldn't say, then it probably gets posted pretty quickly. If I've said something I shouldn't have said that needs to be edited, then it will be a little bit slower. But yeah, to find it, do exactly what I did here. Follow down to the Learn Coaching, come over or subscribe to the Trader Talks channel. There's that blue logo in the bottom right of your screen. Looks like YouTube in blue. Click on that. That subscribes you to it. And then you see this look here. And then this is where the class will be posted here, right in the straddles and strangles. Okay. Very good. I'm hoping I don't say anything bad, so you get to watch it really soon today. You can watch the replay on. All right, head back over here to one more trade I want to take a look at here. We have enough time, we can do this. Let's take a look at this chart here. This is non-event related. Okay, this is not anything that's happened out in the market this weekend, right? Nothing with Venezuela. This is a stock, Oracle, pretty big name. It's kind of an expensive stock here. What's it been doing these days? Just sitting here, plop, 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 not moving. If you're in a long position there, it's really annoying. Maybe if you're in a short position too, it's really annoying. It's not just doing a whole lot. Well, we're going to kind of take advantage of that here today. See if we can maybe capture a little bit of premium there. So let's come over here to the trade tab. And let me come back to, let's see what strikes I was thinking of here. See if it still makes sense. I was looking at 195, and it does look like the 195 is our current price. That's going to be our at the money strike price here. And so what we're going to do, we're going to sell a short straddle here again. Look at the bid and ask price, 410 by 425, not too extreme. 470 by 450 by 470, not so extreme. And let's see here. I did something wrong. Let's delete that. Let's try this one more time. I'm going to hold down my control key, put on the bid price here, There we go, 877. Do you think that's going to tie up a little bit of money in our account? Probably will. If we were to just do one contract, selling a call, selling a put, bringing in that premium, it's going to hold up about $3,900. Now, in some accounts, that might be just ducky, right? You might not, you'll be fine, no problem. There might be other accounts you're like, I can't do that. I need to have a hedge in there so that one, I can afford to do the trade and keep my risk in control. So we're going to edit this. We're going to add to this trade, and we're going to just basically get our hedge. We're going to go out and buy our hedge. We're going to go out a couple of weeks here. I'm thinking here, if we go out to, let's see what January, you know what? I actually was looking at January 16. I'm going to change this trade up here. Let's go January 16, has even a bigger credit. You can see there's quite a bit of implied volatility priced in here, 55%, 51%. Then our hedge, we're going to go out 2 weeks to January 30. Okay. And here we're going to buy a strangle. We're going to buy an out of the money call and out of the money put. We're going to go about 15 bucks. So here we're going to go on the call side about 210. It's about 15 bucks out. It's going to cost us 405 for this hedge. And here we're going to go to the 185 or 180. We're going to have to go 180 here, buy it. It's going to cost us 370. So that's going to be our net credit on the trade. Now, our expectation here is we're going to try to basically collect time decay while keeping a short hedge in place. And now it doesn't tie up nearly as much money in our account, maybe here about $2,400. Okay, we're just going to do one contract here. Right now, it's at a credit. For your homework assignment, I want you to do this. If you want to follow along and do this as a paper example trade in your paper account, you can. What I want you to do is maybe do the analyze trade here. And if you're familiar with the risk profile, we'll just do one of these trades. That's counting the one I did earlier. Kind of see what it looks like here, because it looks like I've got our break-even points here. We'll do it again. So slices to the break-even. Got 2 break-even points. And there's kind of our P profitabilities at a 195 strike where we have those short legs. But there might be a time frame here, maybe a $10 window one way or $5, $7 on either side where you might go, I'd be happy with profits in sort of a range here. That's what that profit and loss line is, blue one. That options expiration, this purple one is as of today or whatever date you've got going on down there. All right. Why does it say credit? Because we're actually bringing in a credit into the account. Yeah, the ones that we're selling, it was 13 bucks worth of premium. It was juicy. Okay, but we need some protection, which is why we're buying our hedge legs. The 210 on the call side and the 180 on the put side. $15 on either side, roughly. Okay, we're going to put this in our straddles and strangles bucket, and my time is up. Man, we covered, I think, a lot of ground here today. Talked about maybe how we might take advantage of the news event over the weekend with the situation in Venezuela, the geopolitical situation. One thing to mention there is sometimes there could be additional risk because of maybe a news event in another country, even a news event in our country. Okay, there could be some additional geopolitical risk with those two trades, SLB and what do we do? Delta? No, we didn't do Delta. Halliburton. Yeah. All right. There are any trades I didn't catch up with here? I'm going to remind you, please fill out the survey on your way out. It's easy to do. Plop, plop, fill in the radio button 1 to 2. If you want to answer that question, send me a message. Happy to hear what you might be interested in. And again, I like to incorporate those things into our coming up classes, so feel free to do so. Karen, thank you for your help in the chat. They kept you a little bit busy here today. Have a great little break for 15 minutes. Then Barbara Armstrong's going to be here right at the top of the hour with trading a smaller account. All right. We'll check on all these positions next week. Have a good week. Bye-bye.